Hi everyone, today let's talk about NYCB Bank. Do me a quick favor and like and subscribe and watch the video till the end to help out the channel, and let's get started. So NYCB Bank started having issues. You can see this article came back all the way on 31 January, so this was the first time that we knew about some of their issues. And they started to garner attention when they fell 46% on that Wednesday, with a surprising net loss of $252 billion in Q4, which was the largest single-day loss for the stock. Obviously, that's a massive loss. And the question is, how does this start to affect the other banks? And you can see we were starting to get some sympathy plays. Some of these other regional banks were starting to fall, potentially signaling that this might be a little bit of a contagion. That's always the concern. Will the regional bank sector see another decline after the multiple failures and multiple acquisitions that we saw during the SVB crisis? And there's a couple of interesting things here that we have to note. So this is the first time the company did get over that $100 billion mark, which starts to put it under higher regulatory scrutiny. This is an important point, and we'll continue to talk about that as we go through. Also, interestingly here, they did cut their dividend, but they didn't stop the dividend altogether. They really just cut it in half, and they started to provision about $552 million in provisions, and then they provisioned $552 million for potential losses, signaling that there's a deterioration in credit. They also saw deposits exit by around 2%, which is substantial, especially for a $100 billion bank. If that continues, that's what starts to cause the banking failures that we were seeing during SVB, bank runs, people pulling as much money as they can, and that's generally what actually collapses the bank to begin with. And then the last note here for this article is somewhat ironic that they actually were one of the acquirers during the Flagstar Bancorp and Signature deal. They purchased $38 billion in loans from the FDIC, and now the company is in a tougher spot. Potentially those loans were not as profitable as they were hoping, and now they're kind of on the other end of that bad credit. Later here, the CEO said that they were preparing to come out across that $100 billion bank, understanding that they would be under more scrutiny in that category 4 bank. And then with that, you can see the dividend cut. It's still 5 cents versus 17 cents. So they actually cut it by 2/3. So they cut it down quite a bit, but they're still trying to pay a dividend, even though the bank might be in trouble, which is interesting, perhaps indicating that the bank might not be in as much trouble as being projected. But right now, the focus is all of that bad debt. They're signaling approximately $185 million in charged off credit. Moving over to this article from the first, there's just a few things here that I wanted to highlight that it does not mention in the other one. They did purchase Flagstar Bank, all 40 branches, and it's fully owned by NYCB, so they're going to operate that as a subsidiary, which I thought was interesting. They also show the charts here. We'll talk about that later on the charts. And then they mentioned here the FDIC chairman coming out and saying perhaps they failed to recognize and understand the risks associated with the things that they were purchasing. And the CEO came out and said that the purchases from Signature Bank were strategically and financially attractive for the time as a unique opportunity to add money to the balance sheet, adding significant low-cost deposits as well as middle business supported accounts from over 130 private banking teams. Again, I think that's waiting to be played out. We're not sure how that's going to look yet on their balance sheet, and right now it's not looking great. Fast forward here to 1 March, you can see the bank fell another 25% after a failure to disclose internal controls by the CEO, and then the CEO was replaced. So we got some commentary from the CEO in the previous article, and now you can see on 1 March the CEO is now being replaced completely. So potentially his analysis of those assets was not the best, and it's starting to put more pressure on the stock, down 25% when it was already down approximately 47% in the previous article. So big pressure here. You can see that chart continuing to downtrend really aggressively into the 3s. They also put out an amendment for their fourth quarter results, putting more internal risk, putting some more money aside again. So the company facing some significant hardships. And then you can see here the new CEO is actually the previous CEO of Flagstar Bank, which they acquired in 2022. And now you can see Moody's did downgrade the bank to junk status. So that is not great. We'll see how that plays out for them. That means they're going to be paying more in interest, and they're already in a tough spot. And you can see shares are already down 65% year to date. So things are not yet getting better here for NYCB Bank. And then on 6 March, they did get a pretty significant cash infusion of $1 billion capital raise. This came from several different capital funds. Steve Munchin was the primary here at Strategic Capital, adding that money. And then as a result of that, it did bounce 25%. They were actually halted up nearly 30% for the day. Prior to the release, the stock was already down that 42%, so it's still definitely down. But this is a lifeline injection here for the company. It'll be interesting to see how that plays out over the longer term. The stock was below $2 a share prior to the injection, and they do mention again that junk status, so they're still paying significant interest on any kind of debt that they're acquiring, and then that material weakness that we saw previously definitely still affecting them. And lastly here, before we get into the charts, I wanted to highlight that category 4 bank. So you can see this is how it works. Category 1 is the highest. They have the most requirements here, and then category 2, 3, and 4. And you can see other firms, anything between 50 and 100 billion. So they stepped up into that category 4, and here are the additional requirements. You can see they did have risk-based capital here previously, and that continues. But the big piece here is they have to pass their stress testing. So stress testing, additional requirement for them. They also have to meet the standardized liquidity holdings. They have to maintain certain amount of liquidity. They also have to report every single month, and then internal reporting here for liquidity. So a significantly increased reporting criteria to the FDIC to make sure that they are maintaining proper levels of liquidity. And this is the big indicator here, and I think this is part of why we're seeing some additional information about this bank. They are in that new category and we're getting more information. And the reason that I think this is important is that all of these other banks that are currently not in this category 4, all of these regional banks that are either in other firms or below, I wonder how many of them have the same issues as NYCB. If they were put into these same stress cycles and liquidity standards, would they be reporting the same kind of issues that NYCB is reporting? And if that is the case, then there's potentially more risk on the horizon. Doesn't mean that we're going to see it, and potentially they could fly under the radar because they're not having those same liquidity runs when this is highlighted in the news, where people are just trying to get all of their money out, but that could indicate a significant structural weakness underneath the regional banking industry. And then moving over to the charts here, starting off with the monthly chart for NYCB. As we always do on this channel, you can see this company goes all the way back here to 1993, went public at $1.19. So if you bought it right at the open, you're still in profit, but not by much. And you can see on the open, it went on a significant bull run, decent little pullback here in the 2000s, ran all the way up to around $35.50. And since then, it's kind of been slowly downtrending, dipped all the way to $10.30, which is just about the same exact price it was before we had that significant drop off, rallied up into the 18s here in the mid 2015s. And then again, you can see that significant downtrend, touched the 200 a couple of times. And it actually was kind of interesting here, ran into that 200 before pulling back into that mid range of this consolidation, and then tagged that 55-month moving average right before we had those significant moves down. So pretty interesting, and you can see all the volume coming down on that selling once we knew there were issues with the bank. Moving over to the weekly chart, again, you can see that big move, all of the volume coming through, way higher volume on that selling. Probably short sellers trying to make some money in there, went straight down from that 1050 and then didn't really bottom until that 350 area. And then now we've been kind of flat, actually had a positive week there, momentum starting to roll to the bull side a little bit, pretty interesting. So you got the initial drop, consolidation, holding. So you can see here 31 January, the time of that first article. Then you had that second drop 1 March here on that second article that we were talking about. That's when the CEO was coming out and saying some pretty brutal things. And then we get that liquidity injection on 6 March like we talked about, which has since stabilized the company, and it is still holding in here. Pretty interesting actually. You can see quite a lot of volume coming through at that level. $3.50 seems to be relatively defended, maybe $3.45. And you can see actually some bullish momentum in RSI holding above the SMA. Obviously, I'm not saying that this is an opportunity. There's probably better places to park your money, but right now it seems like Bancorp has at least stabilized. And so far, I've not heard anything about them dropping off that 5-cent dividend. So still paying a little bit of a dividend. And it was down on the Friday session, about 4.5%. So it's not dropping off super aggressive. In terms of trading, it is moving quite a lot. You can see up 4%, down almost 7%, down another 3.5%. So in terms of trading stock, definitely moving a lot. Let's go ahead and look at the hourly chart here. And it's actually managed to get above that 200 SMA a couple of times. So we got above it here on 13 March. Held a retest, rallied up from there, and it is slowly trending higher. So the slope of the 200 is slightly positive, which is interesting. It is not above it right now, and it is actually below all the EMAs and SMAs, below the RSI here. Pretty interesting. Not what you would want to see, and you can see momentum as well. Also slightly bearish, but starting to trend towards bullish. So it's definitely shown some structure around that 3.4, 3.5 range, and it seems like it has stabilized, and we haven't really gotten any news over the last couple of weeks. So pretty interesting. Again, I don't think it's the best place to be. There's probably better opportunity, but if you're looking at this bank as a longer term holding, this would probably be the place to do it. It's relatively cheap compared to its peers because of all of the risks. And if it doesn't go to zero, there's a good potential that it goes back to $10 over the next several years. Let me know down in the comments section what you thought of this video. It's definitely outside of my normal set of videos, so if you like this style of content, definitely let me know. And if there's any other topics you think would be valuable for a video like this, also put that down in the comments. Otherwise, like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.